General advice warning. This information is of a general nature only and does not take into account your objectives, financial situation or needs. You should consider the product disclosure statement issued by Plantation Capital Limited in deciding whether to acquire an interest in the passive income USA Commercial Property Fund. Past performance is not a guarantee of future performance. No earnings estimates are made. Part 2, how does it work? What I'm going to do for you right now is run you through a little diagrammatic explanation for how your money ends up invested in commercial property and how the returns from that commercial property end up in your pocket. To begin with, you would invest your money in the Australian Managed Property Fund, which is the Passive Income USA Commercial Property Fund. And in return for your investment, you would be issued with units in the Australian Managed Property Fund. The Australian Managed Property Fund would then look to seed a US trust. And what does that mean? It would send money over to the US Real Estate Investment Trust, which is what REIT stands for. And that effectively is a trust over in the United States of America. In return for the money sent over, the US REIT would issue units to the Australian Managed Fund and also a loan, because some of the money sent over will be debt and some of the money will be equity. Now, why a loan? The answer to that question is because interest returns in the United States have a lower withholding tax than rental receipts. So in other words, what we want to try and do is minimize the amount of tax that is taken out at the United States level. And the way that we do that is by sending some of the money over as a loan, because then we get an interest repayment, and some of it as an equity investment in the form of units. You may be wondering, if it's so advantageous, why don't we simply just send all the money over as a loan? And the answer to that question is because there are laws that stop us from doing it, called thin capitalization laws. So we need a minimum amount of equity, and we'll seed the rest via loans and get paid interest on it. So we then have money in the US Real Estate Investment Trust, and that goes and buys US commercial property. In return, it will receive rent and cash in the form of realised capital gains if values go up and therefore the properties are sold over time. Working our way back up then, we have the US Real Estate Investment Trust, which will make an income distribution back to the Australian Managed Property Fund, which is the rent that's collected, the realised capital gains and the loan interest. We then have the Australian Managed Property Fund that makes 6 monthly distributions back to you of the rent, the realised capital gains and the loan interest. What about tax, I hear you say? Well, there's 2 types of tax we need to worry about. First of all is income tax, and then we need to be worried about withholding tax. So in regards to income tax, the US Real Estate Investment Trust does not pay any income tax provided it distributes the money back to unit holders. The Australian Property Fund does not pay any income tax provided it distributes the money it receives from the US onto the unit holders, which means at the end of the day, you will be paying income tax on the distributions you receive from the Australian Managed Fund, and the amount of tax you will pay is dependent on what your marginal rate is. In regards to withholding tax is tax deducted at or in the US to distributions sent back to Australia. Now, the way that withholding tax works is that there are different rates for different types of income, from 10% for interest to 15% for rental distributions, all the way up to 35% for capital gains. Now, to avoid double taxation, you are allowed in Australia to claim a credit for any withholding tax that has been deducted on that money to ensure that you aren't double taxed. So practically then, you will declare in your income tax return the income that you receive by way of distribution, and you will get a credit for any withholding tax that has been deducted on that distribution. So that's the income side of things. In regards to the capital gains, well, let's start with part 1. Remember that the US assets are owned by the US Trust, which is controlled out of Australia. Then, as the value of that US property goes up, so too does the value of the US REIT. As the value of the US REIT goes up, so too do the units go up in value that are held by the Australian Property Managed Fund in the United States Real Estate Investment Trust. Then in regards to you, as the property goes up in value and the REIT and the units held by the Australian Managed Property Fund go up in value, so too do your units go up in value in the Australian Managed Property Fund. So how do you cash in as your unit price goes up? Well, unlike a listed investment, which gets sold on the stock exchange, the way that you redeem your investment in this case is that you apply to the fund to buy back the units. And that's called a redemption. And the way that it's set up is that for the month of September each year, we accept requests for redemption. So you are not redeemed by another investor. They don't buy your units. What happens is that your units are redeemed by the fund. And the price that they are redeemed at is simply the monthly unit price at that time, remembering that the units need to be valued each month. So a session conclusion. What you're doing here is that you are investing in units in an unlisted Australian property fund. In return, you will receive cash distributions plus also capital appreciation as and if the unit price goes up in value, which is reflective of increases in the value of the commercial properties that we buy in the United States. You can then sell or redeem your units back to the fund if you want to get cashed out. If you have any questions or need further help, please just give me a call. Steve McKnight in the office on 8892 3800, or you can email me, steve@PropertyInvesting.com.